And when I need to show something, you'll give me right to display my screen, right? Or do I have that?
Yeah, I just turned it on. So
You're the hostess, yeah.
great. So looks like we're live.
Okay.
For all of our members joining us, thank you for joining us today. This is the second event that we've had this fourth week of term. So Monday we had Lee Ming-Ki, and last week we had Alfredo Saad Filho.
Oh yeah.
Both events are on YouTube and social media if anyone wants to rewatch. But today we're really excited to be able to host Professor Anwar Shaikh of the New School for Social Research in New York, who will be discussing his work on real economic analysis. And if there's anything you missed in this talk, of course, it'll be posted on our YouTube page and all our social media after, so you can always go back through the talk if you would like. So without further ado, I'll hand it over and let you begin your talk.
Thank you very much. I want to thank the Oxford Economic Society for this invitation. It would be lovely to return to Oxford someday in corporeal form rather than this, but in any way, I'm happy to be here. I want to say that the outline of my talk and the associated PowerPoint charts will be made available on my book webpage, but not till May 24th. And that page is called realecon.org. And I gather it may be posted also on the Oxford Economic Society page. And also, we only have little time for questions. So if people are interested, I'd be happy to set up other meetings for more extended discussions. And I'll leave that up to you. So let me begin by talking about the logical structure of my book, which is called Capitalism, Competition, Conflict, and Crises. It's 2016, and it's from Oxford University Press. The purpose of my book is to try to offer a coherent alternative to neoclassical and post-Keynesian economics. And I draw on the economic work of Smith, Ricardo, Marx, Keynes, and Roy Harrod from Oxford. Fully half of the book is empirical, because I strongly believe that theory must be related to the real in a double sense. It should be abstracted from the real, and it should be able to go back to the real, as in detail. All data in the book is documented and made available in spreadsheets on my book webpage, which I said was realecon.org. So you can see where it comes from, how it's constructed, and you can update it. Some of the data today will not be updated because it's a lot of work. I didn't have time, but others will, other parts will. So let me begin by the key point for me, which is that neoclassical theory rests on the notion of perfect competition, and in fact, perfection in a variety of domains. And interestingly, the only major other alternative these days is post-Keynesian theory, which rests on the notion of imperfect competition. I'm going to try to argue that neither of these are adequate, that there is a third alternative, which was in the classicals and can be identified fairly easily, which is the notion of real competition. Now, real competition is as different from perfect competition as war is from ballet. Because real competition is about firms attacking each other, undermining each other, stealing each other's market share, and a variety of other devices that are typical at war. And one of the nice things about the theory of real competition is it can explain the kinds of finding that led Kalecki to argue that competition didn't exist because there are differences in inter-industry pricing and profit margins. And the other good thing about it, among other good things about it, is that it provides a natural foundation for Keynes's theory of effective demand, which he famously insisted must be founded on competition, not on imperfect competition. So what is real competition? In real competition, firms set prices. They seek to displace their competitors by offering lower prices. These are competitive behaviors, as any study of business practice will confirm. So in this price cutting, the survival advantage to a firm goes to those with lower costs. Hence, there is a relentless relentless drive imposed on all firms to cut costs, pursue lower wages, to develop new lower cost technologies, and of course, to migrate to those areas where resources and labor is cheaper. This is the ground for the historical struggles between capital and labor over the length, intensity, and remuneration of the working day, for the mobility of capital to cheaper regions, for the never-ending compulsion for technical change. These are well-documented phenomena in the history of capitalism, but they derive from, so to speak, the pressure put on individual firms. These events determine the social historical paths of real wages, labor productivity, and the capital intensity of production. And that those in turn determine the level and path of the general rate of profit. Now, at the microeconomic level, firms continue to invest only if their expected return on investment yields a safe yield, exceeds the safe yield afforded by the interest rate, i.e., only if the expected net rate of return on investment is positive. This is, of course, an argument comes in Smith and Ricardo, and especially Marx, but also it's central to Keynes. And I'm going to come back to how that connection of the two. The net rate of profit, that is the excess of the profit rate over the interest rate, also motivates capital flows across industries. When the price of an industry is high, and it's high enough to yield an average rate of profit, which is above average, then new investment in the industry accelerates until its supply rises relative to demand, and this drives prices down and profit rates down. The opposite occurs when prices are low and profit rates are below average. The result of this process is a turbulent equalization of industry profit rates on investment around an economy-wide average, with the corresponding turbulent regulation of actual market prices by prices based on costs and a normal rate of profit. This is the classical notion of price determination. And in my book, I show the empirical evidence on it. I show how well it works and how it then leads to a theory of relative prices, which also is empirically very strong. I don't have time here to focus on that because I want to focus on something else, as you will see, on trade and finance. But if you're interested, my book is a lot of detail. I should say the book is 1,011 pages after I cut out a couple hundred pages, because I have to cover such a large range of things, everything from micro to macro and all the big topics in economics, including globalization. Now, in the book, I make a micro argument, which is based on real competition, and extend it to the analysis of cost curves, money, profit, bond prices, interest rates, stock prices, and the rate of return and international trade. Of these set, I will focus on stock prices and international trade in a little while. In every point of the book, the theory is compared to other theories, and it is confronted with the empirical evidence, because the point is not just to develop a theory from logic or consistency, but also to develop it in relation to the other arguments, but particularly in relation to the empirical evidence. As I said, real competition provides a natural foundation for effective demand. In fact, exactly for Keynes's effective demand. Aggregate investment, just like individual investment, is driven by the difference between the expected rate of return and the interest rate. And this is what Keynes called the marginal efficiency of capital. This connection between micro and macro incentives for investment therefore allows us to ground Keynes in real competition. It should be noted that Keynes himself insisted that his theory was grounded in what he called atomistic competition, not imperfect competition. And it's also interesting that Kalecki's original formulation of his theory of effective demand was based on the notion of free competition. So neither thinkers who developed the notion of effective demand relied on imperfect competition to do it. My book, therefore, seeks to return the theory of effective demand to its proper logical and empirical ground. Some further points. When we talk about aggregate supply and demand, we're really talking about aggregated supply and demand, because there is no aggregate. It's a sum of the actions of individuals. In that sense, it is based on a micro foundation, though not on the micro foundation of neoclassical theory, because not based on optimizing and maximizing and all the other rational expectations and so on. But I want to argue that it follows from this idea that aggregate demand and aggregate supply stem from issues of profitability. For instance, firms engage in production, which is supply, on the basis of near-term expected profitability of operations. You run a business, you care about its profits, and you make a decision whether you want to keep going and whether you want to expand on the basis of going profitability. And if you want to expand, you have to make a judgment about how that expansion is going to fare on the basis of long-term expectations. So in both cases, there are expectations of profitability driving both supply and investment. But in order to maintain a business, you have to buy materials. You have to pay wages. You have to pay dividends, rents, and interest. And in order to expand, you have to buy investment goods. Therefore, this other side of the decision to maintain and expand supply creates a demand for materials, consumption goods coming from the income of workers and rentiers or recipients of dividends, rents, and interest. And it also creates a demand for investment goods based on long-term expectations. So it follows from this that real macroeconomics, that is macroeconomics based on real competition, is neither supply side nor demand side. It is profit side. The whole opposition in economics between supply side and demand side is, in my opinion, completely wrong, because both sides are regulated by profitability, but not in the same way. And of course, it's true that aggregated supply and aggregated demand never match directly, but instead fluctuate ceaselessly around each other, because these are the results of individual decisions made by individual firms and people on the basis of a variety of expectations. And so there's no reason they should match. But if they don't match, there are feedbacks which cause them to move in another direction. So this is another form of turbulent equalization, but in this case, at an aggregated level, expressed in the form of business cycles and waves of various durations. In none of this do I have any reliance on rational choice and optimal outcomes. There is, of course, a need to explain actual behavior, but these actual behaviors should not be seen as deviations from some Edenic state arising supposedly from imperfections of various sorts. The very notion of imperfection implies perfection. These are duals. And therefore, if one relies on imperfection to explain the real world, one is always coming back to the idea of perfection. This is a kind of motivation, for instance, very important in the Christian tradition, and in fact other traditions, that there was a period of perfection and then the world derived from imperfection. I want to argue that that's a false opposition. Now, we must nonetheless explain how individuals and firms behave. So let me start by individuals, consumers. Consumers will tend to drift in the direction of sellers that offer lower prices. Workers will tend to drift in the direction of higher wages. And employers will tend to drift in places where workers are cheaper or whether they're higher profit rates. In all cases, the individual reactions are of heterogeneous firms, workers, and consumers, and will vary according to more concrete factors. Some of these reactions lead to success, some to failure, some stop short, and some wander off course. That means that when we talk about this drift, we're also talking about diffusion. They move in one direction, but they spread out. And that means that the appropriate way to address the reactions of heterogeneous entities, one appropriate way is to talk about drift and diffusion. We don't need to specify each thing. We need to show that it creates a general pattern. And that means that the mathematics appropriate to this kind of issue is in fact widely available in biology and physics. One of those appropriate tools is what are called Fokker-Planck equations, which are developed in the early days of physics, having to do with the fact that particles move from one direction to the other according to a heat gradient, but they also spread out. And these tools have been there for a long time, but they have not been used because the orthodox theory doesn't have any conception for these. But real competition must have such a conception. So the problem is not one of abandoning mathematics, of saying that mathematics is not adequate, but of finding the adequate mathematics, which is relevant to the theory. Math is a tool, and it cannot be relevant if you don't have the theory. Now, when we come to consumer theory, it's clear that consumer choices are based on socially shaped habits, income, and wealth. In fact, Keynes, when he's talking about the theory of consumption, makes exactly this point. So here we have the effect of class, race, gender, ethnicity, family, and personal history. All of these influence our choices. It's obvious to anybody who's ever observed this and who's ever moved from one social location to another. Markets adapt to consumer choices, but markets also create preferences in many, many ways. Now, this is again obvious. If you watch TV, you're bombarded by ads that try to shape your preferences. You cannot walk down the street without such bombardment. So it's possible on this basis alone, heterogeneous consumers making choices in a variety of ways, you can construct a theory of consumer behavior, which derives the following key elements of orthodox theory: downward sloping demand curves, price and income elasticities of necessary and luxury goods, just known as Engel's law, and the Keynesian consumption function itself. You can show that these are aggregate results of the kinds of interactions of heterogeneous individuals when they are aggregated. And here the mathematics appropriate to this conception is the mathematics of stochastic aggregates and of emergent properties that come when you look at a whole, which acts differently than the individual parts. So the aggregate is not a representative individual. On the contrary, the aggregate is a different property than the individual. And again, Keynes makes this point when he talks about how individual people have many determinants, and then he says, but at the aggregate, the primary determinant of consumption is income and maybe wealth. Now, there's another point. The social and cultural pressures faced by consumers are qualitatively different from the competitive pressures encountered by firms, because firms are always under ever-present threat of extinction. And in most cases, you don't get killed because you wear the wrong clothing and eat the wrong food, but the firms do get killed if they make the wrong decision. Therefore, it is inappropriate to make a symmetric treatment of consumers and firms, as neoclassical theory does. They are different entities, they have different dynamics and incentive structures and different pressures. And in my argument, in fact, I can show that these two are very different in their behavior, but I can still derive the empirical patterns. Now, in my book, I also work on and develop the theory and evidence on macrodynamics, aggregate macroeconomic patterns, unemployment, inflation, the limits to macro and fiscal policy, the distribution of income by race, gender, and class and across countries. That's on my homepage. And in the latter, by the way, the appropriate mathematics is that developed in the tradition of econophysics, which I apply. Again, all of these applications are not only compared to orthodox and to other theories, but also to the empirical evidence, because the object is to show that this framework can allow you to explain what we find. From this point of view, it's fairly easy to track the roots of the environmental crisis and the degradation of resources. As Piketty notes, profit-making neither knows limits nor morality. Capitalism is very efficient, but that efficiency consists of creating profit opportunities and cashing them in. It has created great wealth over the long run, but it's also created great inequality. It drives the absorption of some workers, but it also drives the displacement of other workers. It has the power to create cancer-curing drugs, as well as the production of cancer-causing commodities. In the world today, heroin production and sale, pornography, and sex trafficking are well organized in highly profitable global activities that operate on capitalist principles. So is the dumping of toxins and the cleanup. Capital, as Marx once said, is on both sides. In this light, I would argue that it's quite wrong to relate consequential social interaction to the category of externalities. Both the good and the bad are internalities. So I would urge you to reject the notion of externalities, because there are already signals that you're tied into this world of perfection, this fictitious world of perfection. So that I noticed in one famous textbook that the notion of externalities does not appear in a micro textbook, I won't say which, does not appear till page 166. That tells you how you are trapped in a framework. Now, uneven development on a global scale is also another phenomenon that I address. At a concrete level, when you move away from the broad binding patterns, you must account for the influence of transportation costs, taxes, and tariffs on the mobility of commodities and capital, and also of history, culture, and national restrictions on the mobility of labor. At an abstract level, labor moves from low wages to high level. But you would, and Smith, Ricardo, and Marx never believed that was a description of the concrete. It was a description of the pressure, of the drift and diffusion part of the story. And they're pretty clear about this. And in my book, I track down where they say such things. But on a world scale, you have to further deal with the issues that global capitalism went hand in hand with colonization, with violence, slavery, slaughter of native peoples, the targeted destruction of potential competitors, and a huge transfer of wealth into the center countries. These are also profit-driven activities. In this context, the post-colonial development strategies that sought to confront the world market and successful modern development have often followed a path similar to earlier times, the successful policies in which current center countries rose to prominence through trade protection and trade intervention. Trade protection leads to success in the labor market only if it provides some insulation from global competition, and if that space is used to create competitive products that can prosper in international competition. These are two critical conditions, and they don't necessarily follow. The book by Alice Sampson called South Korea, Asia's Next Giant, really documents that well, and Hajun Chang's book, which is called Kicking Away the Ladder, does the same thing. Now, one of the points I'm going to make in more detail is that free trade does not make all nations competitively equal. As with national competition, it favors low-cost producers in keeping with the laws of real competition. And in a country, in a state, you can't say that every firm will survive. In fact, something like in the United States, something like 50% of firms go out of business in 7 years in good times. So they face a very strong weeding mechanism, and that's profitability. Any business will tell you that. Okay, so I'm pretty close to my time limit, 25 minutes. So I have time to now move to the two things I want to talk about, which is equity prices and the efficient market hypothesis as views by Schiller and by George Soros. And then I'm going to move to the theory of international trade. Hopefully I'll be able to do each one in about 10 minutes so I can stop in time for questions. Standard theory says the price of an equity is the present value of its known dividend stream discounted by some rate of return. This is called the dividend discount model, and the rate of return is assumed to be constant because otherwise you really can't work the model. Under the basic efficient market hypothesis, the EMH, the discount rate is constant through time. On this basis, Shiller sets out to compare the efficient market hypothesis to the aggregate behavior of the stock market. So he begins with a constant discount rate equal to the historical geometric average real monthly rate of return on the market from 1871 to 1999. Now, if the efficient market hypothesis was correct, then with the constant discount rate and a correctly anticipated dividend stream, the theoretical stock price will move smoothly over time. And as Shiller says and shows, actual stock prices jump around a lot. Since the fundamental value of the stock price at the present discounted value already incorporates future movements of dividends, the observed volatility of stock prices essentially is excess volatility. And Shiller's key point is that this excess volatility is not explained within the efficient market hypothesis. Shiller himself demonstrates this excess volatility and then moves on, as he has in recent times, to argue that this volatility is determined by expectations narratives, which he says catch hold, drive up stock prices, and then as these weight of these fade, the stock prices come down. So they're determined by essentially social memes, which pass from one set of people to another. Let me now go to the data. I'm going to go, let's see. Here. No, that's not it. I always do this. Okay. So I want to show first Shiller's data. Oh, by the way, I want to do some advertising. This is my book called Competition, Conflict, and Crisis. Capitalism, Competition, Conflict, and Crisis. It's an OUP book, so maybe you can get it on discount. This is the Turkish edition, which came out a couple of years ago, and this is the Chinese edition, which is now in pre-order. That has nothing to do with what I'm going to talk about, but I just want to bring it up. Okay, so here is Shiller's basic derivation. The dark line is the actual real stock price, and the dotted line is the efficient market hypothesis.
Mr. Shaikh,
yeah,
just really quickly, I think the sharing might not be working yet.
Oh, right, because I forgot to share the screen. Okay,
No
let's see if we go back to that. Where am I? I always make this mistake. Share screen. I think it's this one, right? Yeah. Can you see it now?
Yep, that's working.
Okay, so let me go back to the PowerPoint. Okay, I've got it. I want it. Yeah, okay, can you see the screen, Real Economic Analysis?
Yep.
Okay, so this is the book, which I've already talked about, the Oxford edition, the Turkish edition, and the Chinese edition. There's a Spanish edition coming out, but it hasn't appeared. This diagram, can you see that? Real equity prices and the efficient market hypothesis?
Yep.
Okay, so here's Shiller's main point. Shiller's point is, look, the fundamentals, even though he's fitted the fundamentals to the actual movements of the stock prices, simply don't explain these waves. And so he wants to argue that these waves are determined by other factors, which he now calls narrative economics. There's a wonderful new book out, which you might take a look at. But, and here I need to go back to the text. Well, never mind. But if you look at Soros Soros also has something to say about the stock market, and what he has to say is different from Schiller's. And by the way, Soros is one of the billionaires in the world who made his money on the stock market and also has been interested in philosophy. And his argument is the following. He says that you have to think about three elements in talking about stock prices. One is expected prices. The other is actual prices. And the third, is fundamentals. And on Soros' argument, these three interact in a particular way. If the expected price or expected movement of the price is upward, and this is Schiller's part, because enough people believe that, then the actual price will rise because people will buy it. But if the actual price goes above the fundamental price, then these expectations become increasingly unsustainable. And at some point, you know that the expectations are going to reverse themselves, the price is going to fall, and expectations will in fact drive the price, the sell-off will drive the price below its fundamentals. Soros was asked, well, how do you know where that point is? And he says, when my back begins to hurt. And alas, he doesn't tell us what the fundamentals are, but the argument is clear. And I showed in a paper that you can formalize this in a simple model of three elements, and it gives you the kinds of patterns that Soros is talking about. So that brings us to a third point. Soros does not tell us what the fundamentals are. But the fundamentals in classical economics, in the approach that I'm talking about, and in Keynes, are determined by real rates of return. But which real rate of return? As I pointed out, the rate of return that's central to both the classical tradition and Keynes is the rate of return on investment, not the average rate of return, because after all, old businesses, old plant and equipment are really not players in the movements of money from one real sector to financial sector or from one industry to another. So I measure this by the change in profit over the change of capital, actually the change in gross profit over gross investment. And this is something that Nicholas Kaldor at Cambridge had developed as a measure of the Keynesian idea of the marginal efficiency of capital. Now, if this is true, then the stock market rate of return should be related to the real rate of return on investment. And this is the relation between the two. The dark line is the real return on equities, which is a stock market rate of return. The dotted line is the real return on corporate investment. And you can see, something disappeared, but anyway, in my book, I show that these are quite close to each other, and that, the graph at the bottom has gone out, but their means are very similar, and their volatility is very similar. And you can see that by just looking at them. So this is the idea of turbulent equalization now applied to the stock market, and it helps resolve the point that it helps integrate the point that Schiller makes, which is that these fluctuations of the actual stock market rate from the real rate are explained by, in fact, expectations and narratives, but the underlying center of gravity is explained by what Keynes and the classicals talked about, which is a real rate of return on investment. Okay, so now I want to move to international trade theory, and I'm going to leave this and try to get back to my original argument. You can still see the PowerPoint, right?
Yes, I just see the screen that says international trade theory.
That's right, because I'm moving on now.
Okay, cool.
And here I have data, and in the nature of all these things, these arguments that I'm making are somewhat sketchy. They occupy a lot of place in the book because I have to do with detail what other arguments are and what the empirical evidence is, but you can take a look at those if you get the book. By the way, I don't If you get the book on PDF, then I will not sign it. I only sign hard copies to let you know. So Smith's trade theory is based on competitive advantage. And what that means is that it's based on the idea that trade is done by capitalist firms, exporters, importers, not by nations acting as fictitious individuals. We can talk about the national balance of trade, but nations don't determine that in capitalism. Individual firms do, and they're motivated, as Smith says, by profit. But what allows some firms to become exporters is that their costs are lower in their country and their costs in the other country are lower than that in the other country. So they can become exporters. They can provide cheap goods in another country. On the other hand, imports into a country come because cheaper goods are abroad. So this leads to Smith's key point, which is that in competition between nations, the exporters and importers will be the cheaper producers. The exporters of the country will be the cheapest producers of those goods. The imports that they bring in will be because the other country has cheaper goods, allowing for costs of trade and tariffs, of course, which are barriers, which are bands that they have to cross. So this is the same result as a national trade. The cheaper producers win out. Then, if a nation has a sufficient number of producers which have competitive cost advantage, that nation will be a net exporter. Let's call that nation arbitrarily China. And another nation who has net cost advantages will be net importers, will have run a balance of trade deficit rather than the balance of trade surplus. Let's call that country the US. Hence, free trade alone, according to the Smithian argument, will produce a trade surplus for China and a persistent trade deficit for the US. And these differences will be persistent because until the cost structures are somehow made equal. And this is where Ricardo jumps into the fray. Ricardo says, well, okay, Smith does not explicitly address the issue of the balance of payments. So let me do that. He says, okay, a country with a trade surplus like China will be making more money abroad than it's spending abroad, so money will be flowing into China. The net trade balance will lead money flowing into China. So the money supply will grow in China. In the trade deficit country, which is the US, it's the opposite. It's selling less abroad than it's buying from abroad, so money is flowing out. So at this point, Ricardo introduces the quantity theory of money. And in the quantity theory of money, if money supply grows in China, then its prices will rise. If prices rise internationally, then that'll erode its competitive advantage. On the other hand, in the US, as the money supply shrinks, its prices will fall, it'll become more competitive. The only balance point in this movement will be if there's no net flow of money. And that can only happen if free trade leads to trade balance. So in Ricardo's brilliant argument, he argues that Smith's absolute cost advantage is translated or transformed into a comparative cost advantage. Free trade by itself will automatically create balanced trade between countries. So you don't need to do anything about developing technology and catching up. You just have to allow it to happen. I gave it for the quantity theory of money argument, but exactly the same argument applies for exchange rates, and that's in the book, so I won't develop that here. From this traditional argument, which is the foundation of all orthodox theories of trade, and indeed many heterodox theories of trade, if you don't have a current account balance of zero, that is a sign of interference in free trade, because free trade should make it zero. And usually you have to blame somebody. You can't say the US is at fault for its deficit on this argument, so it must be China's fault. And typically in history, countries which run trade balances have been accused, usually by the countries that have trade deficit, of interfering. There's a huge literature on this. And in a recent paper written by Isabella Weber and myself, which I'll display at the end, we've gone through all the empirical evidence, all the theories, and show how you can show that the classical argument can explain those patterns. The key point of the Ricardian argument is that no matter how unequal the trading partners are, both sides will benefit from free trade under competitive conditions. Now, neoclassical theory adds a further assumption that there's continuous full employment in each nation. Now, if that's true, then even if you have uneven balances and it takes time to get to the even balances, nobody's going to lose a job, or at least anybody who wants a job will have a job. So therefore, the adjustment part will be not so painful, no social cost. When you integrate capital flows into this, you get the benefits of technological progress in the developing countries and the benefits of cheap labor, the abundant natural resource in the already developed one. It is a win-win situation for each side to specialize in what they do. Develop technologies in the center and resources and cheap labor in the global south. And these are well-known conclusions, and any textbook will tell you. I want to argue that they're completely wrong. Let me begin by Smith's point. Nations don't trade, firms trade, and they base themselves on cost advantages. Exporters, importers do the trading, and the dominant motive is profit. Profit is, however, achieved by beating out other people by lower costs. So when we look at the real competition between nations, we find that, again, costs are central. A nation with lower costs on average will be a trade exporter, will be a net exporter, and those with higher costs will be importers. In other words, trade surplus and trade deficit. Now, when you look in trade between countries, there's one thing about the international price, which is different from trade within the country, is that the exchange rate intervenes. The terms of trade between a country are as its exports converted to international currency divided by imports in international currency. And that should be understood from the classical point of view as an international relative price. If that international relative price is determined by real costs in the two countries, and I develop the theoretical and empirical evidence on that in my book, then the real exchange rate is driven by real costs. Now, then we come back to Ricardo's argument. What about the money supply growth between deficit and trade countries? After all, if this argument is correct that I'm making now, China will have a persistent trade surplus and the US will have a persistent trade deficit because of the cost difference, net cost difference. But here, Marx and Harrod both argue that the increase of the money supply in China will increase liquidity, not prices. And higher liquidity means that interest rates will fall. In the US, the opposite will take place. A decrease in liquidity means interest rate will rise. But if there are differences in interest rates between China and the US, China's interest rates are lower than the US, international capital will flow from the lower one to the higher one to take advantage of that difference. And in so doing, the capital flows will cover the gap created by the trade flows. And so you once again end up with the balance of payments on both sides equal to zero. But in this case, that means a persistent trade deficit covered by short-term capital flows. And this is Harrod and Marx's resolution of the problem. And it implies that persistent trade deficits are created and maintained by the free market itself. They're not evidence of interference. They're evidence, in fact, of normal functioning. Now, this argument can be easily extended to cover long-term capital flows and state interventions. And I do this in a paper that I mentioned before. It follows that the existence of persistent trade imbalances does not necessarily signal trade disequilibrium. In fact, it is consistent with trade equilibrium, free trade equilibrium. The last point is we often, when you're doing work on exchange rates, you need to know whether they're out of balance or not. Now, the argument I'm making tells you how to judge that, which is to compare the real exchange rate to the relative costs of the exporters and imports in the two countries. And that I do here. I'm going to show you the data. I apologize that some of the data has not been updated, but it takes a lot of work to get average prices for US and trading partners. So with that, I'm going to go back to, can you see my screen now again?
Yep.
I'm
Yeah.
still on. Okay, good. So do you see the side part of the screen, which I don't like? I'm trying to get rid of that. I want the full screen. Okay, here. Okay, what you're looking now is at the G7 countries, current account as a percentage of GDP. And if there's one thing that's very clear, in the period of fixed exchange rates, which is roughly from 60 to 1972, and the period of flexible exchange rates, trade is not balanced. Among the dominant countries of the world, free trade leads to persistent imbalances. And that is exactly what you expect from the argument I'm making, and is exactly what you don't expect from Orthodox theory. Now, Orthodox theory then has to explain all of this, but from my point of view, this is consistent with the idea of real exchange rates being reflected, it being determined by real cost. So here then is the real exchange rate of the US, which is the solid line, and the adjusted real effective unit labor costs, which is the dotted line. And you can see what it means to say that the real exchange rate, which is essentially terms of trade, is reflected by the costs, as a classical cost-based price argument would give you. This is the same thing for Japan. And again, you see the solid line is the real effective exchange rate, and the dotted line is the real effective unit labor costs, adjusted for tradable, non-tradable goods. And I go into that. That's a standard adjustment in the book. Now, if you want to follow this argument to its detailed development, please take a look at this paper by Isabella Weber and myself, which is called The US-China Trade Imbalance and the Theory of Free Trade, Debunking Currency Manipulation Argument. And it's in the International Review of Applied Economics. We go through all the arguments, all the evidence, the difference in cost, and so on, in order to show that this can be applied at the most concrete level. Okay, so, oops, I am out of that and I'm ready to take questions.
Great, thank you so much. So just beginning, just a couple kind of broad questions in terms of kind of neoclassical Orthodox economics, kind of what made you decide to kind of move away and look for alternatives from these kind of main branches of Orthodox economics, especially due to those being kind of the dominant way of teaching, especially in a lot of institutions today?
That's a very good question. So I went to graduate school in 1967, thinking that economics would teach me how to understand and analyze the world. I come from Pakistan, so obviously that's a very central issue. I happen to be living in Kuwait, where the problem is not lack of money, but the surplus of money. And yet when I walked in, I was stunned to find out that I was being presented with a version of the world, which in my opinion was utterly impossible to maintain. I had very good teachers, by the way. The first year micro was taught by Bill Vickery, as you know, won a Nobel Prize in economics. The second advanced micro course was taught by Gary Becker, way harder, and also a brilliant teacher. I could not make myself understand how you could characterize human beings by utility theory, perfect competition, rational expectations. It made no sense to me in any culture of the world at any time in history. So the question is, how do you start? And one day, Gary Becker came in and presented in his course an argument which didn't rely on any of these and could explain consumer theory, which is the stochastic argument I'm talking about. I was stunned, because here was a starting point. Here was the room for all the heterogeneity that we were experiencing in the 60s and 70s, the civil rights movements, the feminist movement, the anti-war movement, the anti-imperialist movement. These were concrete factors, and we needed to understand the world in those terms. So I moved away from that. I began to study anthropology. I began to study the history of economic thought. And of course, then I encountered Sraffa at the Cambridge School, where a lot of people also had the same sentiments, and I began to find my way forward. It took me roughly 30 years because having a proper foundation means that you have to construct it properly. Real competition wasn't there. I had to find it. I had to excavate it. So a lot of my work was the excavation process. These are great civilizations, Smith, Ricardo, Marx, Keynes, and Harrod, but they don't all fit together, and you can't simply add them up. You have to take the elements that do fit together. So by about 15 years, 20 years in that, I had material for a book. I came to London and I began to, after I left London, write the book. And it took me 15 more years. So the book you're seeing is a product of a lot of time, but I was always convinced that it was possible because looking back, you could see that it had been done once you shed the tendency to translate them into neoclassical theory. It's the other way around. I persisted in that, and it took a long time to solve some problems. The theory of trade was quite hard. The theory of consumer behavior was simple because Becker had already done it, so that was pretty straightforward. The theory of finance was difficult. Thanks to the generosity of Bob Schiller, the data was available, so I could do that. The idea of getting an incremental rate of return, I came across with some effort, and then I discovered that Caldor had already done it, and that it could be easily applied to not only competition between industries and firms, but also to the questions of international trade and macro. I haven't talked about macro at all. Developing macro took quite a bit of work. And I experimented with nonlinear dynamics because I always believed that math is a tool. I'm an engineer by training early, and I believe that math is a tool, but you can't apply math randomly. It has to be appropriate for the question you're asking.
Very interesting. So another thing I would be curious to know is whether in that period of, like you were talking about, 15 to 30 years, especially when you're publishing your book and gathering the data, whether you faced any challenges or obstacles from maybe neoclassical academics who maybe didn't agree with you, or just in general, were there some sort of obstacles that you faced in terms of establishing this kind of new vein of thought?
Well, that's a very good question. I'm part of what might be called heterodox economics. We began to sort of get together as a group in the late 1960s, 67, 68. I was in the strike in Colombia in 1968. I occupied buildings. It seemed to me that the world needed to be understood in a different way. And in the heterodox tradition, the bulk of people doing economics were working on imperfect competition. It seemed sensible that if the world didn't fit the theory of perfect competition, it must be because the world is imperfect competition. I had a training in Catholic training in Pakistan in the early years. I went to a Catholic school, and it seemed to me that the opposition between perfect and imperfect was not a good place to begin. You needed to have another place. And so that's what led me. And then I encountered Robert Halberner's wonderful book on the history of economic thought. Philosophers, the worldly philosophers. I still recommend that book. And it made me realize that there was a whole world out there of brilliant people who had analyzed capitalism as it was, not as how it should be. And that led me to investigate that. And little by little, I began to do that. The challenge was not from neoclassicals who basically ignored all of us and dismissed us. It came from people on my own side, because the idea was that you should work with imperfect competition. Now, there are other people who are working on Marx, and they didn't like this either. So I can honestly say that I have been almost universally disliked by people on my side who mostly believe this is not possible. But it was possible, and there are some important people, Jeff Harcourt, for instance, and Jamie Galbraith, and others who are quite well known, who have recognized that this is a work worth doing.
Very interesting. Thank you again. So kind of digging into some of the empirical evidence, one question here is about when you were talking about equity prices and the efficient market hypothesis, and they wanted to know whether this phenomenon was kind of representative of the entire broad kind of market, or whether there were certain industries that may have been kind of dragging this narrative-based picture.
Well, there are some people who argue that efficient market hypothesis works for individual stocks. And you have a lot of arguments about how individual stocks operate and what determines them. I don't think it does. And in fact, there are many, many models of how stock prices should be determined. The dividend discount model is one, but there are many others talking about habits and behavior, the behavior of individuals, where you want to put your money and so on. And indeed, there are diverse motivations for the stock market. But from my point of view, one of the characteristic things about capitalism is that there is a set of people who take advantage of differences. Now, if the average rate of return in the stock market is different from the real rate of return, then more money will flow into the stock market. And it'll bring that rate of return down. And the other less will go into the real sector. So that's a turbulent arbitrage. And that's not done by you and me. I can honestly say that it's definitely not done by me, because unlike George Soros, I have not been very successful in the stock market. But though I do understand the principle, this is something done by the nature of capital. It seeks differences, and it seeks advantage of differences. And now this can be done in a split second, because the idea of trading at very rapid rates is a way of taking advantage. This generally is called arbitrage. And it is arbitrage that ties the two rates of return together. It doesn't follow that individual firms will have that, because this is the collective result of aggregate firms. And individual prices are very much based on expected profitability. I have work done, which I haven't published yet, which on the Q ratio, showing that this framework leads to another way to understand the Q ratio, and that works very well empirically. And of course, if I could figure out how to do it for individual stocks, I'd be very happy, or even the aggregate. One of the problems is that the way I'm doing it, the data you need is in national income accounts. The stock market data is published virtually daily, but the national income accounts data I need is published 2 years afterwards. So there's no way I can predict the stock market from real data, as far as I know.
So moving to the trade side then, a question here from Giacomo Bianchino, who asks, by your account, should all countries with a positive trade balance or surplus have lower costs? And how do we explain high-wage net exporters like Australia, for instance?
Well, lower costs are not the same thing as low wages. Germany is a trade surplus country. It has lower costs. I mean, that's why you buy those things from Germany, high quality. I have a German washing machine. It's fabulous. And it's certainly, for the quality, a great price. But that's because the productivity is very high. Cost is the ratio, unit labor cost is the ratio of wages to productivity. And other costs, materials costs. Australia has sources of materials, agriculture, land, all of those things which can lower costs in some activities. And that means that Australia can and does have a cost advantage. Look, capitalists don't care about neoclassical theory. They're interested in where they can make a profit. If they're importing goods from Australia, it's because they can sell them where they imported into and make a market, create space in the market because the costs are lower. And there, they will tell you absolutely unequivocally that it's because of lower costs.
So then just kind of more broader question, using these takeaways, what would you say, or what kind of policy prescriptions could these takeaways and these kind of new frameworks lead us into?
Well, there are many policy prescriptions, but let me make two, one of which Hajun Chang has talked about. Hajun says that no advanced country has ever climbed the ladder without interfering in trade, without protecting its domestic industry. That's one condition, but also stimulating its domestic industry to be internationally competitive, because those two things, you can protect an industry against fat and lazy, it doesn't do anything, you remove the protection, it's there, right? So if you want to get into the boxing ring, you can't just run around and pretend to be boxing. You have to be training and you have to have talent, and otherwise you will get killed. So that dual thing, which is exemplified in, say, South Korea's thing, but also Germany, Japan is another case. The United States is another case of development through social and technical change and protection. But this is exactly the opposite of what these countries say the global South should do, because basing themselves on standard theory, they say, well, just let us come in, let us invest, don't try to interfere, because the free market will give you everything. I just don't believe that. There's no evidence for it. And in fact, you can see the devastation caused by free markets if you don't have some way to have your own space, so to speak, in them. I had another point, but now, policy prescription. In the book, I also deal with macro. And in macro, there is an issue of profitability also. And I make the point that the standard opposition in macro is between neoclassical economics, supply side economics, which, let's say in Friedman's case, says the system is automatically at full employment. And so if you pump it up, fiscal or monetary stimulus, you get inflation. So this was Friedman's explanation for the inflation in the 1970s, which is called the Great Stagflation, because in so doing, the economies will not improve, they may stagnate, and therefore you'll get stagnation and inflation. The Keynesians say, no, that's not true. Capitalist economies have room, generally speaking, for stimulus. And if we stimulate them, the effect will be on quantity. Employment will rise, and prices will not rise until you reach full employment. So the neoclassicals say we're always at full employment, so you'll get inflation. The Keynesians say, well, you get employment rise first, and then inflation and wage rise. Now, for me, obviously, you can see in history where fiscal stimulus has a huge effect. And you can see in history where fiscal stimulus runs out of steam. Let me give you 3 quick examples. Hitler's Germany stimulated the economy so much that it eliminated massive unemployment in 1 year. And this is a point made not by me, but by Koletsky and others, massive unemployment. How could it do that? Well, it stimulated the economy that created an increase in aggregate demand, created an increase in employment, but it did not allow wages to rise. It did not allow prices to rise. It did not allow interest rates to rise. So it basically severed the connection between the stimulus and the feedback loop, which would lead to higher inflation, higher wages. Higher wages mean lower profitability. Profitability rose in Germany. The same thing happened in World War II. In the United States and other countries, they had to expand tremendously to come into the war effort, especially the US, which waited and then came in late. And so doing, what Roosevelt did, tremendous budget deficits. Deficits in World War II were 25%, never seen before in history. Yet, no inflation, no fall in profitability, and no rise in the interest rate. The central bank kept the interest rate down. You were not allowed to raise prices. It was called price gouging, and you could be punished for it. And wages were not allowed to rise because that's going against the war effort. That worked brilliantly. In the 1970s, they reintroduced the market, the free market. Then they began to see unemployment, and the Keynesians said, well, we have the tool. We'll do stimulus. We did stimulus. The economy expanded. It was great. Wages began to rise. As wages began to rise, unemployment began to rise again. And so they stimulated again. Output rose, employment rose, but then employment started to fall. And they couldn't explain it. And this is where Friedman came in. My explanation of it is that when wages rise, profitability rises. Wages rise, profitability falls. Profitability drives growth, as Keynes and Marx and everyone else says. That means if profitability falls, growth slows down. So now you're pumping up the economy, so employment rises, but at some point growth starts to slowing down, and that's what we call stagflation. As it slows down, you pump it up more goes into inflation and less into growth. And so you have a theory of inflation. And in the book, I have a whole chapter devoted to showing that this theory of inflation, and this theory of policy limits, by the way, can be valid, can be applied to many areas. And I show in a subsequent article how it applies to Brazil under Lula. And I was greatly in favor of Lula, but that act of pumping up the economy not only had very many beneficial levels, it also led to inflation and stagnation. Now, one can deal with that, but you cannot deal with it if your theory says it's not possible.
Great, awesome. Thank you so much for your talk and for answering all those questions. Just before we wrap up, if there's anything you want to say about your book, any of your work, I'll just give you a minute or two.
Two things. As I said before, I'm happy to continue this conversation if there are enough people interested, because Zoom allows us to do it. So if there are, you tell me and we'll set up something.
Sounds good.
The second is that I urge you not to just take your universe as closed between perfect and imperfect competition. Get out of the Bible and start looking at other frameworks. And I would argue that what I've done is a way to unify a long-standing alternative framework, to apply it empirically. Marx isn't here to apply it to aggregate demand and supply. Keynes isn't even here to apply to macro dynamics in the way that he could had. It's interesting that Marx died at the age of 64 and Keynes died at the age of 62, both of them leaving large amounts of their work that needed to be done unfinished. So that's your task, to try to take seriously more than one alternative. At the New School, we require you to learn neoclassical economics. It's the lingua franca of our discipline. We also teach you post-Keynesian economics and what I call classical Keynesian economics, and students can choose. So keep yourself, and you can't do this if your faculty doesn't do it yourself. Organize courses, organize discussion groups, join INET and other groups that deal with heterodox economics. You can do it.
Great, thank you so much.
Thank you.
For our viewers that are watching, we'll share the link to Professor Shaikh's work after on realecon.org, where he'll have his lecture notes and the PowerPoint charts from the presentation. We'll send those out through our newsletter, which if you're not signed up to, there's a link on our Facebook page. And just looking ahead to next week, we have JP Singh talking about paternalism and collective action, North-South trade relations. So hopefully we'll see a lot of you guys there. Thanks for coming today, and thanks again for the talk, Professor Shaikh.
Thank you very much. Bye-bye.